Hello, welcome to It's Your Smarter Money with Atlas Fiduciary Financial. I'm Dr. Laura, and this is Professor Steve along with me. And we want to talk today about small cap stock and the role that small cap stock plays in your portfolio. When clients come to our firm for the first time with a portfolio, oftentimes we will see that their portfolio is packed with large cap stocks. And by the way, a large cap stock is a stock that's valued more than $10 billion. So these are
That's right.
these big, large companies. And while large cap stock does have a role to play, it certainly is a great first start in building a portfolio. Small cap stock should also be in people's portfolios. And a small cap stock has a value of somewhere between 300 million to 2 billion in market cap.
That's right.
So these small companies are very interesting because they have a potential to deliver outsized returns more than large cap companies.
Yep. At some point, a company becomes so large that there's just constraints on their growth. They just can't grow any longer. Some of these companies, if they continued to grow, they would represent half of GDP. We know that's not possible. So a lot of the growth going forward can come from small companies. And a lot of times the innovations you see come from small companies too.
It's a lot easier to double a small cap company's earnings, right?
Yep. It's a
Right.
simple mathematics, actually,
Mm-hmm.
So, yep.
But the thing about small caps too, though, is so the pro is that they can tend to grow, have higher growth rates. The negative is that their earnings tend to be mostly just domestically accrued or even locally. So they don't have that international diversification component. They tend to they tend to be more vulnerable during times of recession or other market shocks that occur. And so you have to be careful with small cap, even though there's a lot of upside, there's also some downside.
And I want to mention that the diversification factor, the international diversification, we get it in other areas anyway. So with small cap, we don't really expect it there. We expect it more at the large cap. There's some there, but of course, we have a specific allocation to international, both small and large international stocks, and also, by the way, international real estate as well.
That's right. So generally, small caps perform best during the start of a bull market. So what we saw back in 2002, Steve told me March, it was March.
I remember it vividly
Okay.
when it started to recover. Yep.
Okay, March of 2002, which you can see in this chart. You can see the Russell 2000 versus the S&P 500. And there's something I want to say. First of all, the Russell 2000 is the most popular index for small cap stocks. It is cap weighted, just like the S&P 500. Most of the indexes are cap weighted. I think the Dow Jones is one of the few that is more equally weighted in terms of these major indexes. So it is cap weighted. But one of the things you have to consider is that there are 2,000 stocks, 2,000 companies in that index versus the S&P 500, which is only 500 companies. So that gives us some extra diversification right there.
Yes. I think the Dow's still only 30, right? It was always just 30.
But it's equally weighted was my point. Yes, and it is only 30 stocks, which is a small sampling.
Yeah, it's not broad-based, but the Russell
Right.
2000 is very broad-based, as is the S&P 500.
Right. But Steve, I just not sure if I completely made my point here. So during that first decade from 2000 to 2009, we've made it a point of showing folks in the past that the S&P 500, these large cap stocks did not perform. They were negative, somewhere in the neighborhood between 7.5% to 9%. Whereas if you had small cap stocks in your portfolio, that actually had a positive return of 47%. So significantly better in that period.
In fact, a lot of people call that the lost decade for large cap stocks from 1999 to 2009. So that's a great point you bring up there. And look at the difference with small cap.
Now, after that, from 2010 on through around 2020, We saw almost the large cap stocks and the small cap stocks moving directionally together. We often use the term, it's a statistical term, correlation. They seem to be somewhat correlated, although you can see there are a couple times where small caps perform better and other times where small caps perform worse. But what happened in 2021, when we started seeing the start of a bear market again, you can see this is where small caps and large cap actually diverged. So, small cap did really well at the beginning of a bull market, but not so well when we started getting fears around recession and debt ceiling and banks failing and what else? The Federal Reserve raising interest rates, so all the things that have been plaguing the market over the past couple of years.
Yep. I think they also tend to get affected by recession fears sooner than large cap stocks.
Absolutely. Yeah, they're leaders, which is why the presentation, if anybody noticed on the beginning of the presentation, we said small cap stocks as a bellwether, because they tend to be the first ones out of the gate during a market upturn and the first ones down during a market downturn. They tend to hit the bottom before the economy has actually bottomed out. Yep. And then they actually are the leader moving forward. So the small caps, if nothing else, is a specific asset class that should be watched and paid attention to.
Yeah, that's correct. Yep.
Now this slide actually just shows the past 2 weeks, the first 2 weeks of June, and what happened here. And so we've had these ups and downs. I mean, wild swings. So the small cap is known to be a volatile asset class. And over the past couple of years, we've been seeing wild swings, 10% up this month, 10% down that month, up and down, up and down. So they've really been living to their name, if you will. But in January, we saw small caps come out of the gate really strong. They had a return that was close to almost 14% in the month of January. And then, of course, the banks had problems, and there was more talk about recession and so forth, and they came and corrected themselves. But now, the past 2 weeks, we're starting to see it going up again.
Yeah, and it was also the issue with the repricing of various asset classes due to the Federal Reserve raising rates that I think affected small cap a lot, quite honestly. So, but you're right, it's starting to see a big, maybe we're starting to see a transition now, beginning in June. Maybe, maybe not.
Maybe.
We're cautious. Yeah, we don't try to time this. We never will. I just want to mention too, small cap stocks historically have had about twice as much volatility as large cap stocks, roughly, almost twice as much. Especially if you look at large cap blend as opposed to large cap value, it's about double the volatility. Although, which is interesting, I've looked at the history. If you extract, I think the history prior to 1970, small cap stocks have actually showed volatility not that much different from large cap, which is pretty interesting.
Oh, interesting.
Yeah.
Well, so you're saying that they're much more volatile than large cap. We know that. They're also, they tend to give us a better return over the long run.
Yep.
So I think the next slide actually shows that period from 2000 on through 2023, actually as of last Friday, we can see that even though, it's had its ups and its downs, it's still well ahead of the game. And it tends to, if you're a very aggressive investor, you want more small cap. If you're more defensive and you don't want to necessarily ride the roller coaster, then you want a smaller percentage. And Steve, our portfolios have the range you are.
Anywhere from somewhat over 2% all the way to 12%, depending on the model. 12% will be the percentage that's in our most growth-oriented model, and roughly 2.5 to 2.8% would be the percentage of small cap that's in our most conservative model.
Okay. But you know, again, the folks, I mean, we have a couple of folks in this most aggressive model.
Yeah,
You and I are not even in the most aggressive model there, but we do have
I'm
a
one
couple of
below
folks. But
it.
they're willing to, they know they're in it for the long run and they're willing to take the
Yep.
ride. So that's why it's so important for us to really be able to monitor how you feel about the markets and whether you can stomach. And you're just looking at this slide, it's hard to really imagine. You know, it's kind of a little bit tight there, but all the zigs and zags, even the S&P 500 looks like it has a straighter line up
Yeah.
than small cap. It's up, it's down, it's sideways. And
Mhm.
so lately we haven't really had such a great return with small cap. And some people might even wonder, well, why do we have small cap? Well, it's because of the long-term performance. And so
Yes.
we're willing to sit here and be patient and remain disciplined and stay in the asset class.
And so small cap historically is average about 13% a year, somewhat over 13% a year. Large cap, somewhat over 11% a year. And so that may not sound like a big difference, but when you compound that, and this chart you created here clearly shows that the compounding, that 2% a year can make a big difference in the long run.
Mhm.
And so what we did here, and this is kind of a complicated chart, it's more complicated than it looks actually. And you can see in red, we plotted a standard bell curve. If anybody who understands statistics understands that bell curve. Anybody who's been graded on the bell curve understands it probably too. But we've plotted the actual monthly returns in blue for a small cap going back to around 1978 till now. And you can see that, especially on the negative side, that the occurrences of negative returns has been much higher than one would expect if these returns followed a bell curve. And so we see more extreme events with small cap, and that's why we are cautious regarding how much we put it in client portfolios. We know we need some, but we're also cautious. And the percentage we actually have in client portfolios, that wasn't, again, any kind of decision we made without using the mathematics of portfolio theory and the interrelationship between small cap and the rest of the holdings in that portfolio. So this was all done for a mathematical purpose, the amount that we include in there. So, and so also you can see that some of the occurrences for monthly returns are astoundingly high and way above the bell curve. In fact, you can see that there's some that were about almost 14% in a month, you know, and several times that's happened, which is, and I think, Laura, you're going to show that happening in the next slide when we think that happens, actually, or the next, probably next two slides, I guess. And also, what's happened is because small cap has underperformed for the last year or two, the price to earnings ratio, which is the price of the stocks or the average stock in small cap versus its earnings, right now for small value is only 8-1. So that's really undervalued. Whereas a large cap value, the large stocks are 15-1. In those are paying $15 for each dollar of earnings. And you sort of expect that to be reversed, right? You'd expect that because the prospects for small cap stocks are probably higher in the long run because they have new products. They're maybe in a new market that no one's been in it before. You would expect those price to earnings ratios to be higher, but actually we see the reverse. It's almost half.
Well, they are very, very cheap right now. They are cheaper
Yep.
than they've been in decades, honestly.
Yeah.
These PE ratios, and I looked up a couple of other metrics, uh, price to book, price to
Yes.
sales,
Yep.
even price to cash flow. All of them are just ridiculously low. So
Yep.
they are definitely very attractive.
Yes, they are. And even US small blend is pretty low too. And blend that
Mhm.
includes you know, all of the small cap, not just the value ones.
Right. And I asked Steve to not include growth on this chart
Yep.
simply because while growth shows the same dynamics, there's some other things going on with growth right now, which really is a whole nother conversation. And we
It
didn't
is.
want to get bogged down in explaining that because that is another video on its own. But we thought we would share with you what the majority of the market is doing between value and blend.
Yep. Yep.
Now, this slide I have to apologize. I don't know where I got it. If I got it from somewhere specifically. I know a lot of people have seen a chart just like this, where people are told if you stay out of the market even for a month and you miss the upturn, you're going to leave earnings on the table. And the reason why I liked this particular chart is that it shows the same story, but it's much stronger, and it shows an average of bull market starts over the course of the past 100 years. And on average, small cap stock in the first year delivered 63.8% return in the first year. But if you missed that first month because you were sitting out because you didn't think small cap was behaving so well, you left a third of that gain on the table. So it's important to know that, again, to time the market. We won't know when the market is starting to behave well and when the economy is starting to recover until we're well into the recovery. It's very, very difficult to know that. I can tell you that the consumer sentiment is very low right now, which oftentimes is an indicator that we're getting ready to start moving out. But again, our crystal ball isn't working.
No, we don't know. It's too hard to try it. This is also the reason why we can't time these things right here. And we actually, in one of our other videos, I know we showed a graph showing the return on the S&P even in the first 2 or 3 months after recovery starts. And you're looking at an average of between 15 to 25% in the first 3 months. And you can pretty much, double, triple that for small cap when a recovery occurs. And typically small cap leads the way. And that's why we call it the bellwether. Leads the way when we begin to recover the economy, leads the way out of a recession. And so we don't know when that's going to begin, and we can't miss that.
We don't know that, but what we do know is that we will experience a recovery, and we will be positioned because every single one of our clients is positioned in the small cap, and we will participate in that turnaround and that additional growth.
That's right.
So it's all about having patience and maybe a little bit of a strong stomach can help as well. And that's what we're here to do, is help you have the patience and be disciplined and stick with the strategy. And know why you're holding different asset classes. Very, very important.
That's correct.
So I hope you found this helpful. We're always available to speak to you about any questions that you might have in terms of your portfolio and how much small cap stock you have in your portfolio. Please feel free to give us a call. Please like the video and subscribe to our videos as well, because again, that's very helpful in terms of getting our videos out. And let us know what other topics you want to hear about. Thank you, and we'll see you soon. Bye.